And how about the depreciation method? If you have any ideas about the methods, put on.
Straight line.
Yeah, straight line, the most popular method, yeah, and it's easy and simple, right? And what else? Anything? That activity. Let me find it out. Methods, activity method, straight line method, yeah, and diminishing, okay? Diminishing is basically depreciation charged more in the earlier periods, okay? So what method to apply? It depends, okay? It depends the assets attributes, all right? So if the value is decreasing evenly, then you can apply straight line. Okay, if the value decrease based on the activity, for example, like how many units were produced or how many hours worked, that will affect the value of the PPE, then probably activity method is better, right? And some of the ES digital double decline methods. So these two methods charges more depreciation expense in the earlier periods. All right. So if you have assets, have this kind of attributes, then you can apply either one. Some of the ES digital declining balance method. All right. And what about, okay, so what about the some the other issues? Let me see. The component depreciation. What is component? So when we talk about PPE and depreciation, generally we think it as like whole period, right? Mm-hmm. And the whole period probably like one year period. But often PPEs are required not in the beginning of the period, right? They are required like in some point in the period, right? And some other issues like if the PPE is a huge PPE, then it has different component and with a different useful life. So how do you apply the method? You know what I mean? So, for example, the airplane. Okay, so the airplane has major components, and those components may have different useful life and different residual value. Okay, so in this case, IFRS says that you should use the component depreciation. All right. Well, it's easy. It's just that you put the different component into calculation. All right. For example, this one here, the EuroAsia airline purchased an airplane, and for how many is this? 100 million, right? On January 1st, 2020. And the airplane has a useful life of 20 years and residual value of 0. And it used the straight line method of depreciation for all its airplanes. All right. If it is all the same, you don't do the component, and you will just take this 100 million minus the residual value and divide it by the useful life, right? But if now there are major components with a different useful life, so as this table here, then you will do them separately. All right. So yeah, we do it this way. So the same here, we apply straight line method. Then you use the same method here, but with 20 years divided by 20 years. And for engine components, it is divided by 8, and for other components by 5. So you have the total component depreciation of 8,600,000. So that would be, the amount would be different if you put all the components as a whole with the same useful life. All right. So therefore, I first prefer that business to do the component depreciation. All right. All right. That is one concept. So the depreciation entries. So we generally do these entries at the end of the period, and we put it as an adjusting entry. All right. Okay. So when we do adjustment entry, the date of the entry, we use the last date of the period. Okay. And what else? The presentation. And the presentation in the financial statement. Generally, you can see, the whole amount of the PPEs. Well, not the whole amount, I think. There were some major PPEs that you could put in the financial statements. And that's the accumulated depreciation. So you understand depreciation expense and accumulated depreciation, right? Do you? Puno?
The accumulated depreciation amount, depreciation calculated over an amount of years.
Oh yeah? Yeah, where is reported to?
Recorded to.
Yeah. Not sure? What about you? What do you think? Okay. Yeah, depreciation is the estimate value for the decreasing of the asset. Okay, and depreciation expense will be for the period, reporting the period to the income statement. It is I would say it is an allocation, move from the cost to the expense. That's how it works, the depreciation system. You know what I'm saying? So you have, for example, you have 1 million of the equipment here, so you spend 1 million, purchase that, okay? And when you purchase that, you record it as asset, right? As asset, okay? And then you use that, and the value, in the beginning, the value of the asset is 1 million, but what if, it is used after 1 year, and would the value stay the same? No, it decreased, right? So we suppose the value decrease evenly every year. So we apply a straight line method to reflect the decreasing of the value. Okay. So the depreciation system is to move the cost, which stays in the asset account, and now because it's already used, the asset make the sacrifice, I should say, sacrifice to help the business operation, right? And the value decreases. Okay, so we move part of the cost, part of the cost to the expense, because this expense supports the business operation and makes the bringing in the revenue. All right, so you move part of cost to expense. All right, and the depreciation expense will be the part of the cost moved to the expense, so that report to income statement. All right, and the accumulated depreciation becomes a control account of the asset account. So the asset account has a value of 1 million. Now, for example, we take off 100,000 from the cost, move to the depreciation expense, right? So now the net amount of the asset will have how much? It was 1 million. Then we take 100,000 to depreciation expense. Yeah, 900,000. Yeah, and after second year, you move another, 10,000 to depreciation expense. So therefore, we temporarily use the accumulated depreciation to accumulate the depreciation moved, right? So the first year you will have 100,000, and the second year you will have 200,000, and the net amount of the asset will be decreasing by 100,000 every year. Okay, until to the end. To the end, if it is like useful life 10 years, then the value will become 0. Yes, yeah. But if there is an estimated residual value, we should keep the residual value. We don't put the residual value into the depreciation. Okay, that is the concept. All right. So actually, depreciation, is there anything? I mean, does the depreciation affect cash flows? Yeah, correct. No, it doesn't affect cash flow. It's just, to move the cost to the expense. That's it. Okay, you got it, very good. How about Furumo? Did you get that? Yeah, that's depreciation. All right, so the presentation, you will see something like this, but in some report, they don't really show accumulated depreciation. They show net amount. They only show net amount. For example, this one, they will only show 91,400,000. All right, and then in the note, you should be able to find some of the details. What is the component? And the other is other depreciation issues that I just mentioned. Most of the time, PPEs won't be purchased in the beginning of the period. They can be purchased any time in the period, right? So in this case, we can do partial the depreciation for partial periods. Okay, so prorate. So we prorate the depreciation expense between the periods. For example, if you purchase one asset on, let's say, on July 1st, so what would be the proportion that you will do depreciation Furumo?
What?
If you purchase the asset on the first day of July, so how would you do the depreciation? Because it's not, it's not purchased in the beginning of the period. So at the end of the period, how are you going to do the depreciation for this asset?
For the amount of time you had it for, I guess. For the amount of time you had it for.
Oh yeah, good, yeah, that is the prorate. We prorate that. So how about the time? Because it's purchased on July 1st, so it's 6 months. So you do 6 months. You don't do it all year. All right. Well, because we have the management system, so it's the system can do that for us. But if you do it on your own, that will be very time consuming because you have so many PPEs, right?
Also, in that case, would you do it every 6 months?
No, not really. So for the first year, because you purchase on the July 1st, so for the first year, you only do 6 months for the first year. And after that, because it will be used for one year. Okay. And if the useful life would be 5 years, so you will depreciate it for 6 periods.
Yeah.
You know what I mean? Yeah, 6 months for the first year, and the 6 years for another 6 months. Yeah, that's it. In practice, I want to say something. In practice, if you have so many PPEs, because they are purchased in different time, right? So they would do something like, if they are purchased before January 1st, then the depreciation will do the whole period. Okay, some PPEs may be purchased after July 1st, right? And for those, no depreciation. You know what I mean? So the amount, the depreciation can be like trade off each other, and the difference won't be material. You know what I'm saying, no? Yeah. And some PPEs, if you might purchase on like July the 7th, right? So do you count for the month or not? So you need to have like a cut point.
Yeah.
Yes. So generally you can put it like in the middle of the month. If they are purchased before the 15th, then in this month you will count.
Yeah.
After that you won't count.
Yeah.
Yeah, that's the way, we do in practice. Right. What else? Straight night. Yeah, these are the straight, okay, so let's quickly look through the illustration. Okay, well, we have introduced 4 methods, right? So this is the example here. Let's see. Okay, the company, Maserati, right? Purchased new machine, okay, on August 1st. So this is the partial period. And the cost of this machine was $150. The company estimated that the machine would have a service value of 24 at the end of its service life. So the life is estimated 5 years. And if working hours, estimated at 21 hours. So now you can, with this information, apply different method. And the depreciation will probably, are different, right? So one more issue is that, can you change the depreciation method like often? Like this year I apply straight line, next year I feel like to do activity method. What do you think? Any ideas?
It's probably legal, right?
Legal or illegal?
It's legal.
It's legal. Yeah, I think it is legal as long as you can justify it. But always, keep in mind there is one principle: consistency. Consistency. Okay. Yeah. All right. With this information, if we do straight line, okay, let's quickly go through this. All right, Vivian. Vivian, are you Vivian? Okay, pay attention, please. All right, so let's quickly look through the partial period, the depreciation for partial period. All right. So now here we apply straight line method. The asset is purchased on August 1st. So therefore, there are how many months going to be depreciated? 5 months.
Yes.
Yes. So we only do 5 months. So you take this, the cost is 150 minus 24 residual value. Okay. So you have depreciable base of 126 and multiply by 5 and divided by 12. Right? Yes. So the first year. And the second year you will do, so this is the depreciation entry, adjustment entry here. And the second year you will do, actually you do the whole month. How about the third year, 80? So do you do 5 months or you do 12 months for a third year? You're not sure? In the full year, the whole year. Yeah, and the third year and the fourth year,
Full.
yeah. Yeah, because they used it for the full year. Okay? Until the last one would be made on the sixth year. So another, it's not another 5, it will be the 7 months.
Yeah.
Okay, so the last one will be 7 months and 14 and 700. And the remaining will be, this is the accumulated depreciation. How about carrying amount? Yeah, I mentioned this term, carrying amount, CA. So at the end of the depreciation, what would be the CA for this asset? Carrying amount. CA. CA amount, another term is book value. Yeah. So what would be the CA up? The CA in the beginning would be 150.
Yeah.
Okay. After the 5 months depreciation, your CA will have 150 minus 10,500. All right. And then each year you minus the depreciation. Okay. And at the end, after the depreciation is taken out, and the CA will come to the residual value. Right? Okay, now question. Okay, let me ask you a question. The useful life is an estimate, right? So what if after the useful life, the machine is still usable? How are you gonna do that?
You could probably extend.
Hmm?
You could probably extend.
Yeah, we can probably expand it. Yeah, we keep using the machine.
Yeah.
Yeah, but you can, because there is a salvage value of, in this case, it's 24. So you can do depreciation until the 24,000 is taken off. All right, and if the machine is still usable, then you keep using the machine.
Yeah.
Then don't do the depreciation because all the cost is already moved to the expense.
Yeah.
Okay, that is the idea. All right, but sometimes the machine may be outdated. Okay, and the depreciation is not taken up yet, and you will have to abandon it. Yeah, we will talk about that later. We need to, sell the machine or dispose the machine or abandon the machine.
Yeah.
Then we will have to take all the balances of the book. All right, and how to do that, we will talk about it later. All right, do I make it clear here? Do I make it clear? All right, and this is straight line. Let's look at the activity method. So the depreciation is taken by the activity. All right, in this case what is the total hours is 21 hours, and the depreciable base is only 126. So as long as the machine works per hour, and the depreciation will be, taken for $6. Okay. So if the first month, the first year, how many hours? 800 hours. Then you will just multiply it by 6. So the depreciation for the year is 4,800. Okay. And how about the second year? What do you think? It depends on the hours used.
Yeah.
Okay, yeah. That's it. And how about some of the years digit? For this method, you still do 6-year depreciation. All right? But see, the first year you only do 5 months, and the second you do the whole year. Okay, that's it. So that is the concept. So at let's see, 1, 2, 3, 4, 5, 6. Okay, so in year 2024, this is the 6th year, right? So all the depreciable base are already moved to depreciation expense, and the remaining is the 24,000. Yeah, it's the residual value there, and that is the CA, the book value after 2024. That's it. Yeah. And see, the depreciation expense recognized is different, right? It goes by the method that you apply.